Christophe, great to have you back on Real Vision.
Good morning, Roger.
We're here to talk about Recession Week, but what I really wanted to sort of chat to you about was Raoul's been talking about a kind of a thesis, a big thesis, of which one of the key elements in that is going to be the role of central banks and whether central banks can provide liquidity. What I wanted to chat to you about is that, when I look at the market, I see all the yield curves and I look at the 2s, 10s, which is trying to sort of turn higher. Didn't quite go negative, but we did go negative on 3-month 10-year, and obviously 530s turned higher last year. So in combination, all these things are sort of saying we go negative or we turn higher, recession comes 12 months later. And there's a whole bunch of other indicators out there which are very, very similar. So it's suggesting to me that recession is imminent. Now, the chats we've had, you think that the messaging from yield curves might be slightly different and that we're in a new central bank paradigm. Could you maybe explain to us what your view on yields and messaging from yields is and how that ties into this discussion and argument that you've been having about central banks that goes back well over 12 months?
Sure. It's first of all, I never ignore a message sent by the fixed income market. I really think that whatever the message is, it's a very key signal that we have to look at very carefully. We know that pre-GFC, the usual steep flattening of the curve and the inversion of the curve, especially if the inversion was lasting at least a quarter, and the subsequent steepener was a very strong signal that the recession was imminent. Is it still valid? I've got a reservation, which is very simple. It's when you've got 13 trillion of negative yielding fixed income instruments, I'm massively convinced that it is impacting the shape of the curve one way or the other. Where do you have duration, liquidity, and a semblance of yield in the world? The US Treasuries market. So basically, I'm massively convinced that the flattening of the curve and the compression of the risk premia is as well a consequence of this need for duration and the need for fixed income liquidity.
So what you're saying there is that rather than the bond market anticipating a recession, what you're effectively saying is that the global pot of bonds have gone negative, have forced foreign investors into US Treasuries or the US bond market and the notes and the Treasury market, and they're buyers of these instruments, which has been pushing yields down. Now, wouldn't some people say, well, okay, but it's a similar sort of thing because the Europeans are seeing a slowdown, which is the reaction from the central bankers to force into negative rates. And so all we're doing is we're just transmitting the slowdown across the Atlantic, and eventually, well, the messaging is the same. Is that not a valid argument?
The fixed income market is sending a very strong message, which is the neutral official rates from the major central banks is far too high. So it is anticipating a very meaningful action from the central banks to move their official rates more in line with what I call the new paradigm, which is very subdued inflation and very poor growth. One way I look at it, it's I've created what I call the major central banks official rates index, which is an average of the 7 major central banks rates. So Fed, BOJ, ECB, Bank of England, RBA, Bank of Canada, RBNZ. And I plot it against the Chinese GDP growth. And it's staggering. It's just the correlation is very strong, meaning that we have moved into a new paradigm, which is what I call the flatlining environment, where in fact, central banks have to move lower their neutral rates.
So we've basically seen a kind of a global convergence of GDP into sort of mid to low single digits, because remember, you used to have double-digit EM and you had 3 in the US, but now we're sort of, everyone's between 1 and 5 or 1 and 6 or whatever. So you're seeing that convergence, but I guess in terms of the sequencing, because everyone's seeing a slowdown, it's pretty much clear. We've clearly got a manufacturing slowdown. And people see the slowdown potentially morphing into a recession. But then the key question for the central banks, or the central bank impetus here, is, does a slowdown become a recession? Can central banks stop that? Or if we get a recession, let's say it's a capex recession in the US, can we have central banks act in a way which prevents equities or risk assets from selling off so that a shallow recession doesn't turn into a significant global deflationary event or a depression or anything like that. How does this new paradigm of central banks come into that and prevent the sequencing from following those lines?
I think that when you look at for example, pre-GFC, we went into the massive downturn with official rates at 5 to 7%, with a balance sheet almost empty, with low deficits. So there was room to, in fact, to kickstart the economy and to basically save the world. We are now going to a real downturn, and there is no way to omit that. It's not only on the manufacturing; it's broad based. Even if the services economy activity is still quite resilient, but you see just like creeping under the surface some imbalances which are very concerning. We are going into that downturn with official rates in low twos, two major central banks with negative interest rates, 14 trillion of balance sheet. So basically, the ability of the central banks to answer the way they did it in 2008 is very limited. The problem is they can't afford a burst because they don't have the meaningful tool to address the consequence of a massive downturn. So they will need to be very preemptive. And I think that this is the message we have this year. In fact, last year, what the central banks have tried to do, they tried to rebuild monetary policy ammunition to be able to address a potential recession. They realized that there was no room to rebuild those ammo. So this year is a big shift, which is all about, you know what, we can't rebuild the monetary policy ammunition, so let's try to avoid any burst at any cost. And this is what they are doing. They're going to try to be very preemptive. And what is interesting is they know they will not be able, I think they have no illusion about their ability to kickstart the economy. I think they have no illusion about their ability to boost real inflation. So these mandates are quite an illusion. So they are focusing on what they can do, which is keeping the financial conditions as loose as possible. And that was the message of the Fed yesterday, to be honest. When you look at the minutes, they know that they can't backtrack, because backtracking would mean just like a massive unwind of the 2019 risk parity euphoria, which was the main achievement of 2019, to be honest. So I think that they have to focus on, they have decided to focus on loose monetary financial conditions and to keep the term structure as low as possible. And this is the best way to deal with the massive debt burden at the end of the day.
And people often sort of look at the central banks and say, okay, what we're effectively saying here is don't fight the Fed, the ECB, the Bank of Japan, and the PBOC, etc. But then people say, well, hang on a minute, in 2000 to 2003, the day they started cutting rates was pretty much the top of the market. I think you had 4 days of euphoria. Similarly, in 2007. And you can see perfectly that the equity sell-off is exactly in line with the rate cuts. Are you saying that in those occasions, they delayed too long, and on this occasion, they're preempting it? And some of the moves that we're seeing in yields, which you could extrapolate forward and say recession coming, actually those moves in yields are anticipating central banks trying to prevent the slowdown turning into a recession.
When you look at pre-GFC, we had four main episodes, 95, 98, with preemptive cuts from the Fed. They managed to engineer a soft landing of the economy, and the equity market just rallied. 2000 and 2007, far too slow to cut rates. The market, the equity market just sold off even before the Fed cut. We are again in a different paradigm. We are post-GFC, and I really think that what has been the main takeaway of the last 10 years, the disconnect between financial assets and real economy. It's not about GDP. It's not about inflation. It's about these markets are extremely addicted to central bank largesse. If they come and put another few trillion of liquidity in the market, I think that the disconnect we have at the moment with fixed income just plunging, diving, and equity market rallying can last a little bit more.
Is there a sort of danger that this central bank activity, if we, let's say, take 2016 as an example, where whether we got a Shanghai Accord or not, or whatever, we had China putting liquidity in, theoretically a Shanghai Accord, the Fed did a relent. And I always call it the top that never was. 2016 looked like the tops of '07 and 2000, but it never turned into anything worse because central banks came together and they all agreed to put more liquidity into the system. Today, we've got central banks in a little bit more of a beggar thy neighbor mentality. Clearly, with the trade war, I'm not sure the PBOC is going to necessarily agree with the Fed this time round, and the ECB is in a messy place. Will they be working independently, or will they club together? Because that seems to be the key here. If you get a misstep,
No, I think it's a to be honest, for me, it's the cornerstone of the current dynamic. And I think it's very important that you go back to 2016, because what was the most important part of 2016? It was concerted actions between the central banks. And we ended up with, between March 2016 and June 2017, something like 2.5 trillion of cash injection. But even more importantly, you had the Accord de Shanghai, which was meant to put pressure on the US dollar. This will not happen. How can we have a concerted action to weaken the dollar in the current growth, inflation, and trade uncertainty? You really think that Europe will say, you know what, you're putting tariffs on our products, and we are going to be foolish enough to shoot ourselves in the foot and to let our currency appreciate? Obviously not. So we are in a competition between the central banks to outdove the superdove, to do more than the neighbor, because basically they don't have many ammunitions. So one key pillar of their strategy is to weaken their currency. And you're just exporting deflation. And this is a zero-sum game. And I think that it's quite interesting that even if we are in a trade war, which is a currency war, the G7 implicit FX vol is at all-time low, because you have a spike, and what the central bank is doing is just selling the spike to bring it back lower. So in fact, it's a zero-sum game.
So within that, you were talking about the doves have to outdove the doves. And as we talked about earlier, one of the one of the worst parts in terms of this whole sort of central bank kind of framework is that Europe is in a mess. It's a basket case. And the appointment of Christine Lagarde, or the nomination of Christine Lagarde to lead the ECB, is a sort of a tacit acceptance that they've probably got to do more than just a monetary. They've got to get the fiscal side going as well. So can we go through each of these central banks? What can each central bank do? If they're not going to work together, they've got to work aggressively themselves. Europe's not got much ammo. What are they going to focus on?
So before talking about that, Roger, I'm going to just add on something on the why I think that the central banks will have no choice to do more. It's because at the moment, the fiscal expansion tool is very limited, and for various reasons. In the US, you have a political gridlock, which means that I don't see any bipartisan support for some infrastructure program ahead of the elections. The Dems will never give a gift to Trump and to see him potentially boosting the economy. In Japan, interestingly enough, they seem more obsessed to raise the consumption tax at the moment rather than doing any program of fiscal expansion. In China, we know that the deficits are already 11% of the GDP, and therefore it's already a very levered system. So the room to do much right now is very limited. On top of that, the transmission channels of liquidity are impaired. And then you have Europe. So Europe, for the time being, I don't see that fiscal expansion is coming in a very short term, because anything with Europe takes time. And you still have, the Maastricht rules, and you've got the legendary German budget orthodoxy. So I think that the nomination of Lagarde is a very strong signal, but again, it's going to take time. So in the meantime, what the ECB would do? I think that more rate cuts, I think is going to be very limited for one reason. It doesn't work. And you take the risk to damage even more the banking system. Raoul had a very interesting post over the weekend about Deutsche Bank, but it's not, Deutsche Bank is not idiosyncratic story. It's the overall European banking system, Japanese banking system, or Swiss banking system, which is not very surprising considering that the three central banks are already in a negative interest rate policy. So I think they're going to do more QE. They will just, in the meantime, they will just keep the term structure as low as possible because it's an easy way to deal with the debt burden for the time being. You're just reducing the debt servicing. And basically it doesn't cost too much for the different European countries.
So Europe's kind of stuck in that one area. You say the banks, I mean, what they will do will probably see the banks continue to underperform because the banks have to, but it's a death by a thousand cuts. So it might take X number. And you're right. I mean, you look at the overall banking sector, I mean, the whole thing is on its knees. It's at the sort of 30-year lows.
And just on the banks, Roger, I find mind-blowing that we don't even realize that the banks are supposed to be the provider of
the engine,
the engine of the real growth. Yeah. And not only they have to fight with negative interest rates, but on top of that, they have to fight with the post-GFC regulations. So basically, we always go back to the same topic. It's post-GFC, we thought that MV equal PQ will work, but M is not the issue. The real issue is V, and we still haven't addressed.
And if you could just go through M versus that equation, if you could just explain it for the...
Just the fact that if you increase the monetary base, it will end up by boosting the real economy and the output. So to make it very simple, why it didn't work in post-GFC? It's because we just flooded the market with new cash, but the cash never went where it was supposed to go. And one of the reasons is the banks just were not the transmission channel they were in the past.
I mean, basically a low velocity of money and basically became a misallocation of capital.
And on top of that, you have also the debt burden, which is impacting the money velocity. And it's interesting to see that since GFC, when you take the global amount of cash injected in the system divided by the global GDP, it has collapsed, which means that even $1 extra of cash injection by the central banks equal less than $1 of real GDP created. So we are already, to some extent, reaching the limit of the monetary policy stimulus. But they know that. The purpose is not to boost the economy because they know they can't. It's to avoid the burst.
So it sounds like the ECB is relatively impotent for the next 12 months. It'll do more of the same, but more of the same means death by a thousand cuts to the banks. Does that mean that the Fed has to do the heavy lifting? And they're still tightening their balance sheet, they're still running it off. Do you think they're going to stop that soon, as well as cut rates? So are they literally going to come back and say, okay, we're going to do QE4, and we're going to get rates at the front end back down to pretty much zero? What's their game plan? And are they the key for the global system? Because it sounds like Europe's not going to be that much of a use to anyone.
Now, Europe is not going to be a use for anyone. It's just going to fuel further the risk parity. But the Fed, what can the Fed do? They have to follow. To some extent, we are talking a lot about the Fed independence. But when you look at over the last 8 months, the monetary policy of the Fed has not been independent. In 2018, the Fed has been what? It has been reacting to the tax reform from Trump, has been reacting to the potential inflationary impact of the tariffs, and has been reacting to the political pressure by over-tightening. So to some extent, it was a reaction to the political environment. Since the start of the year, the Fed had to answer to the super doves. Don't you think? I think it's quite symptomatic that in June, twice, the Fed had to become very dovish because the previous day, Draghi and ECB were even more dovish. They can't afford a staggering rally of the US dollar. But this is the case for each central bank. We are in a very, I think, fierce competition, which is a big difference compared to 2016.
So with the sort of what the Fed's doing, are they targeting, or will they have to target certain assets? Because when you look at the world, we've got this enormous, or particularly in the US, but globally, we've got this enormous pile of credit. So the stock of credit. And as everyone knows, in the US, triple Bs is around about half of the total. Europe's a long way behind, but it still had a lot of credit expansion as well. Are they going to have to target these areas? Because the big risk is always the knock-on effects. You kind of might have something happen in China, or you might have something happen in Japan, or it might be just something no one had thought of. It might be the trade war. that creates a chain reaction which goes beyond the central banks? Or do you think that the central banks could, let's say this all turns into a recession, could the central banks create, and particularly the Fed, create enough liquidity to stop the recession turning into asset destruction? What are they going to target? How do they break that loop?
I think we are just in front of the biggest bubble ever. And do you remember we talked about it last time? It's what has been the sequence since 1999. In fact, we had a bubble burst, heavy consequence. We have created a bigger bubble to deal with the consequence of the bubble burst, and so on. We are now in the ultimate bubble, which is just inflating the financial asset to keep the financial conditions as loose as possible. To basically give, when you look at, is Italy better than 6 months ago? No.
Not at all.
Will Italy be better in 6 months' time? Of course not. The difference, we are below 2% on 10 years, which in fact impacts massively the debt servicing of Italy, which is helping to some extent offset the fact that growth will be very subdued. And I think this is when you look at where high yield, European high yield can raise cash, to some extent, some of them can just do it in a negative yield. So basically, you've got European corporates able to be paid to borrow money. This is quite crazy, but I think this is one of the cornerstones of the current dynamic.
And you talked there about the three, we're in this third bubble. And I think some people would argue that we may have already reached the Minsky moment where there's certain things going on sort of global framework where once a bubble bursts, there's not much you can do about it. Now, you're basically saying, no, the bubble's not burst. Central banks have got its back for now. But it's got to go, it's got to reach that point of no return. Are you just saying it's not next year, it's 2 years down the road or 3 years down the road because the central banks just know they've got to put in a lot more liquidity just to keep this whole charade going?
What was to some extent the beauty of the previous cycles? We had booms and bursts, which was to some extent making the task of the central banks much easier, because when you have a boom, you just manage to raise rates and to create some margin of maneuver in terms of monetary policy. We don't have booms and bursts. We just have like a very disappointing growth outlook. We have a baseline with basically some ondulations. So basically, again, they can't afford the burst. So they will try to prevent the potential downturn. But don't make me wrong, this is a very, very tricky journey. And I call that the tightrope walk of the central banks, because things will not improve. So when you're trying to stay on the baseline, you still have the cliff on each side, and it's a very dangerous journey. Because I don't think that Chinese growth, what were the two main pillars and engines of the world growth for the last decades? Globalization?
Yeah. This
will not improve. Okay, we had some friendly talks in Osaka, but we all know that it's just a joke, and we will hear very soon that a deal is done at 90%. But 90% doesn't mean anything. What is 90%? It's the part that China is ready to make concessions on. The problem is the 10%. The 10% is the usual backdoors that China use to not comply. They will not negotiate on that. So the best case scenario here is they're going to talk and they're going to talk. I don't think that Trump will go into a much aggressive rhetoric before the elections. But the big risk is if he's reelected, because he will not care about a second mandate, and this will become just wild. But the uncertainties are still prevailing. You can see with the tariffs against Vietnam. I'm absolutely convinced that the next target will be Europe and on the auto sector. We saw with India. It's quite scary to see that even Japan and South Korea are, starting a trade war between the two. So this will not basically improve. On the other side, the second engine was Chinese growth. If you look at the forecast from the OCDE and even from the NBS, Chinese growth should be at 5.4% by 2020 and below 4% by 2030. So the world growth, I don't think, will get better. And we are in what I describe as a flatlining environment for a much longer period. But any small event can just change the outlook. And the obvious one, and I completely agree with Raoul, it's if I'm wrong about the conflict between China and Trump, and we have a re-escalation in the next few months, that's going to be very, very tricky.
So it sounds like we've got a convergence basically. So we've got convergence of GDP, we've got convergence of asset price returns, pretty much convergence of volatility. All volatility, as you mentioned, is getting there. So is your outlook therefore kind of this lower for longer? So rather than we crater into a full-blown recession, you actually think that central banks can keep us at this kind of ideal level, which might be 1% to 2% growth, where every quarter people go, we're going to go over the edge, but they provide the liquidity, and we extend this low growth environment in which yields continue to converge, growth continues to converge, volatility stays where it is, the stock of assets continues to rise, meaning that the ultimate end game becomes potentially worse. Do you think is that your outlook? Is that your sort of 12-month outlook?
Yes, my 12 months outlook, it's more just more central banks globally, and the super doves will take out the bazookas, and they're going to do more, and forcing the other ones to do more. It's a massive. It's maybe the biggest bubble we have ever seen in the financial markets ever, and I am very scared about the final outcome, but I'm not sure that they have the choice. I always talk about what I call the central bank's ladder, monetary policy ladder toolkit, with 8 different steps, starting with conventional rate cuts, going down to debt monetization. We are already there. What are the central banks doing? They are just monetizing the debt, nothing less, nothing more. When you've got the BOJ, who has something like 45% of the total GGB market, yielding zero, to some extent, it's like the red line. The red line of the government is the mirrored in the BOJ central bank balance sheet. So I think it already doesn't mean too much. It's just numbers.
And with the sort of, you talked about one thing that could flare up and kind of break the framework is the flare up in the trade war, which I guess would also be potentially currency renminbi. But are there any other things out there? I mean, what if we get a death spiral on European banks? I think it's going to be a slow death rather than a death spiral. But let's say we got that, or what if Raoul talks about the rate of change of LIBOR 2-year on 2-year LIBOR has had this very, very aggressive move, so off the very, very low levels. And when I think you bring that forward 36 months or lag it 36 months, it shows that you'll see a sudden tightening of financial conditions. Can a central bank provide sufficient liquidity? Because when we're talking about central bank balance sheets, we're talking 19, 20 trillion globally, 4 or 5 in the big nations. But that's dwarfed by the size of the financial asset stock and the overall economies. I mean, are you talking that here they're not going to do, that we're not talking about another trillion, but another 4 trillion of QE, so doubling, in order to be able to make sure this bubble, which keeps on getting bigger, doesn't hit that tricky moment?
Interestingly enough, Roger, I came to the conclusion a little while ago that you can't underestimate the central banks. And I think that those limitations are almost intellectual. Would you bet on Kuroda not going absolutely wild? I will not bet on that. And I will never bet against the ability of the central banks to go into what I call the twilight zone of the monetary policy. I think there are no limits. And look at the ECB. They start to buy ETFs. They still have a lot of stocks available. So I think that it's quite a desperate situation. But what can they do? In fact, in 2019, I think that the biggest problem we have is they've been so far down the road that it's almost impossible to backtrack now. 2018 has been a good example of that. As soon as the central banks are not providing the usual amount of cash into the system, it's just falling apart.
And so in terms of kind of preparing for this, and I guess where I think it's almost the biggest question here is that, and I talked about it at the very beginning, the recession, is it a slowdown that turns into recession, and the recession could turn into something bad for equities? But then if you take this logic that you're talking about, the potential for a recession should reignite QE. And if you do I've got the chart of 5 central banks balance sheet versus the S&P, and it's the same over the last 10 years. So basically, the QE comes before the recession, rising the equities. Is that going to be one of the sort of ways to play it? I mean, should people be getting long equities here?
I had that discussion this morning with one of my customers, and it's we talk a lot about the disconnect between what we saw as a very anxious message from the fixed income saying, "Wow, recession is looming." In front of that, you had the S&P just rallying to a new all-time highs, and again, I think it's the strong belief, broad-based belief, that all the central banks will put rates much lower, and the Fed below 1%.
But isn't that similar to, going back to those previous 2 peaks, the Fed cut rates we had effectively not quite a blow off top, but markets went higher for a few days, few weeks, and then the view was, well, actually, no, they can't resist it. Or again, you're saying that they're actually being early this time. They've
been slightly earlier, and again, before GFC and after GFC, I think is a completely different game. I think that if you they've got the way to put trillions of cash in the system through QE, and I think QE will be a main pillar of their actions, especially for the ECB and the BOJ.
In terms of trading this, and I'm going to go back to, we had an interview back in March, and your interview there was buy gold because central banks are going to go absolutely mad in terms of this world, and you buy gold because they're going to try and preempt the recession. And we saw that break. In fact, actually, the breakout in gold, I think, was when we just overtook the previous peak of negative yielding debt. We went from 12 to 13, didn't we? And that's when gold went. Is that still the right trade here?
I am massively convinced. I never been as bullish as in the past on gold. I was bullish when we met in March, and gold was trading 1,300. I still believe that real yields will go further lower. And I still believe that because you're going to have so much cash injection, plus a currency war between all the central banks trying to put pressure on their respective currencies, so you have a risk of debasement of the fiat currencies. I think the gold has got a golden mix in front of it.
And what sort of target are you looking for on that?
I remember my first target was 1,500, and so I will keep it like that for everyone, but I think it's going to go higher.
And in other areas, I mean, a lot of people are thinking the way to trade this is various parts of the yield curve, so buying bonds, either buying bonds or notes at the front end, buying treasuries at the back end. Do you think that's still the right trade? Do you think there's juice in that, or should you be buying Eurodollars? Some people would say, actually, you know what, Eurodollar 100 calls, maybe 2 years out, because actually the US will go negative. Do you think that's the sort of thing to do as well?
I think that, you know what is the main risk for me? Because I'm going to go back to your question. It's the main risk is a much higher dollar. And I still believe that despite all the calls that the US dollar should reverse, I think that you still want to be long of, I think that the better looking currency within the ugly, and the US dollar is still the right one. Why do you want to buy against the dollar? Well, we discuss about that as well. There is nothing that you want to hold on a very long term. It's still the reserve currency, and I think that there is still imbalances in the US dollar funding. So I think that you need to be long of treasuries. And I will personally be more focused on the 5 to 7 years part of the curve rather than the long end. I don't like the long end for some reasons, but I will focus on the 5 to 7 years.
So you're thinking that the long end will worry about inflation,
at
so
one
the
stage,
will go a little bit higher in the front.
So I still think that the curve will keep on steepening. Not necessarily a huge steepening, but I think that the trend is still in place.
So it's the 530s that will probably maintain the steepening in space.
Yeah.
Okay, and so in terms of, you talked about the dollar there, with FX vol being near the all-time lows, the dollar basically, I mean, shouldn't it just be a grinding move? And we've seen that it just goes up a bit, down a bit, up a bit.
Yeah.
Isn't the big move of the dollar kind of the end game actually where all this breaks down, because then it's a pile back into the dollar? So isn't the dollar when the central banks fail?
Yeah,
Exactly. So it's not the catalyst, it's the aim.
I think it's going to be the outcome of a failure.
Yeah. Okay.
And it's going to be the outcome of a massive funding, global funding issues. And this is, it's what is the big difference between the ECB and the Fed? I think the ECB is ready to do anything. I think that the Fed, to some extent, is still a bit worried about the magnitude of the answer they should give to the market. They still want to be seen as independent, and they're thinking that too much now will be seen as an allegiance to the White House. The ECB can promise negative rates for 30 years if they want to. The Fed can't do that. So it's going to be, whatever people think, I think it's going to be very difficult to outdove the super dove.
Do you think that, so going just flying back to the dollar before we sort of wrap it up, but do you think that the dollar therefore is, although we're going to see, we've got the ammo from the Fed to potentially come down, and people say, well, rate differential, but it sounds like within that, as they cut rates, US assets become more attractive to everybody else. And so people come in, if you think rates are coming down, you probably think US 10-year yields are going to fall to 1 or below, and therefore you just want to get long for the capital gains. So do you think that the dollar, even though most people say they're cutting rates, therefore dollar down, but actually that will just attract capital into the US and not offset it?
But the issue I have with that is basically, even if let's assume that the Fed cuts 25 bips in July and 25 bips in September, so 50 bips, you still have, let's say, 250 bips of positive carry against the euro. And if the ECB does 20 bips of cut, in fact, it's the 50 bips of the Fed are not enough to make to improve, in fact, the carry when you are, just to reduce the positive carry of the dollar. So basically, I think that the Fed to put pressure on the dollar needs to do a lot and very quickly. And I don't see that happening in the next 6 months. So I still think that the long dollar is still the trade.
And so then to summarize, you're basically saying that what we've got here is we've got a very clear slowdown, but the central banks are early, they're aggressive. And so therefore the sequencing really is, we might see a shaving of global GDP down towards maybe the magic zero, but we won't plummet through yet. They'll do everything to keep it. And so these signals that we're seeing are affected a little bit earlier. Actually, the signals that we're seeing are actually not the same as the signals we're used to prior to the GFC.
I think that the signals might be slightly different, but they are worrying enough to have the central banks intervening. And I am convinced that when you have rates at 6%, you can be a bit patient before going into easing mode, because you know that you can cut by 300 bips very quickly. When you have rates at 250, you know that you have to do it quick to give the kickstart very before that the global picture becomes more worrying.
Shouldn't they do 50 straight off?
This is why the Fed task is so complicated compared to the ECB. If they do 50 after telling us in May that everything is fine, equity market will think, wow, they know something we don't know. Or people will think, why? We have an unemployment rate at 3.7, they're cutting 50. It means that they are pleasing the White House. So they have, to navigate between all these potential criticism or creeping worries to give a little bit and not too much and not too quick. This is what is the main challenge of the Fed.
Great. So, well, thank you very much. It sounds, in some ways, it's a sort of, and I think as we discussed with gold, it's a sort of semi-optimistic outlook based on the ability of central banks to step in and maybe offset the worst that we might be expecting.
Yeah, because it's again with gold, it's definitely not an Armageddon scenario, because the problem with the Armageddon scenario, you have a broad-based deleverage, and we saw it in 2008. My main scenario is like, you know what? We need mediocrity. We love mediocrity. We're going to say mediocre for a longer period of time. Mediocrity is much better than a burst. And funny enough, what is potentially the biggest risk now? It's much better data. And that would sound a bit extreme, but financial markets need weak data at the moment. Not too weak, but not too strong either. It has to be weekish.
Brilliant. Well, it sounds like we fight another day. Thank you very much once again for coming on. Good to see you.
Thank you very much, Christophe.
Thank you.